Uh, let's find out a peg ratio for S&P 500. I don't think it's here. Okay, it's an old number. Oh, we can look at the SPY. Maybe that's a little bit better. Let's look at SPY, which is ETF for S&P 500. I don't know if they have statistics maybe on the profile. Given the growth numbers are similar to Microsoft, so I'm going to assume a PEG ratio 2. I'm just making the crap up. So slightly lower than Microsoft. Even compared to S&P 500, NVIDIA is much cheaper. And a big portion of, I think NVIDIA accounts for about 4% of S&P 500 market cap. The top 10 accounts for over 70%, by the way, I think. Taking those estimated growth numbers seriously, this basically says, if I'm a hedge fund, I'm going to buy NVIDIA, I'm going to short S&P 500. Done. That thing is going to make you money. In fact, you can even do that on a very leveraged basis using futures contracts. There is even an ETF that is leveraged NVIDIA. If NVIDIA goes up by 10%, you make 20%. And you don't even have to do any margin for that. Look that up. All right, we have about 10 minutes. What else do I want to talk about? Oh, there are two more ratios. I'm going to include them just for completeness. One of them is price to book ratio. It's the price divided by total equity per share. One of the reasons you have that is if earnings are negative or zero, PE ratio doesn't make any sense. Okay, it's not even an issue of interpretation. It's just not there. Book ratio is almost always not, book value is almost always not negative, but there are cases where it is. For example, if you looked at the books of American Airlines, their total equity per share is negative because they had a lot of book losses during the COVID years. They're not all cash losses, but it's there. Another one, this was actually used quite a bit back in 90s during the dot-com boom, price sales ratio. All sales can never be negative. It can be zero sometimes, but they can never be negative. And I wouldn't compare firms based on that. What's their profitability on those sales? Doesn't matter. It doesn't give you an apples to what you want to call apples comparison. In fact, price to sales may even give you, apples to steak comparison. They're not even the same species. One ratio that I use quite a bit in my own analysis, this is called, it has a fancy name, enterprise value over EBITDA ratio. EV is short for enterprise value. One of, among other things, there are minimum two more issues with price earnings ratio. One, it doesn't look at the firms differently because of leverage issues, because you're looking at market value of equity, not market value of the assets. And two, uh, companies have non-cash expenses. And depending upon their accounting practices, that could make a big difference. If a company is using a lot of stock options, that generates a lot of so-called stock-based compensation. And those are things that are not coming out as cash, but it reduces the earnings. Similarly, depreciation, firms that are investing heavily have a lot more depreciation compared to firms that are not. So that doesn't mean that those firms that are investing are not doing well. They just have to write off a lot of depreciation right now. And sometimes you want to separate, since you want to separate leverage, you want to take the effect of interest out as well. Also, you want to look at the tax differentials. Uh, Maybe they made a lot of money last year. Do you know what their effective tax rate is? This includes all federal, state, local, what have you, 14%. Federal corporate rate is 21 or 22. And they're based in California. Corporate income tax rate in California is 12, I think, plus local stuff. Why? Because they book a lot of their stuff abroad. Same thing with Apple. Apple's net federal taxes are zero. Apple pays zero federal taxes. I mean, they pay sales tax and other stuff, but zero federal taxes. Why? Because their headquarters for booking purposes is in Ireland. Ireland has a corporate tax rate of 10%. And unless, according to US tax code, you bring those monies back into US, you're not going to, IRS is not going to recognize that as taxable income. So you just keep it outside. Apple doesn't care. I mean, whether the money sits in US or Ireland, they accept exactly the same money. It's still $1 in China, where they have to pay those little kids to make their screens, right? Because they work for pretty much $1 a day. So whether it's coming from Ireland or New York City, doesn't matter. So if I'm comparing firms, then I got to take that difference out as well. That's why we look at EBITDA. What enterprise value is the following. EV, shut up, is market value of equity, which is a fancy name for market cap, plus book value of liabilities. Since book value of liabilities are typically very close to their market value, you can think of this as, I haven't finished EV yet, but market value of assets. I mean, there is no separate information about that, but accounting identity, basic balance sheet identity still applies. Market value of the assets has to equal to market value of equity plus market value of liabilities. We're kind of waving our hands and say book value of liabilities is roughly the same. And in these analysis, trust me, whether you get a ratio of 33.1 or 32 doesn't make too much difference. 10 versus 33 makes a difference. So as long as those book value of liabilities are within something like plus or minus 10, 15%, you're good. There'll be a big difference on the book value of assets and book value of market value of equity. From this, you're going to deduct net cash. You can think of this as, and I'm going to say what net cash is. You can think of this as the market value, the value you think market attaches to the operating assets of the firm. Because net cash is the following. cash plus cash-like plus short-term investments. For example, Google keeps a lot of cash around. I'm going to deduct something from that. I haven't yet. Google has gross cash, let's say, of about $100 billion. Some other company may not be keeping that much. So if I don't make that correction for that, I'm actually penalizing the other company. Google keeps that kind of money around because if and when there's an acquisition opportunity happens, they want to be able to pay cash. There is actually a trend in the markets the last 30 years. Companies that make their acquisitions using cash actually get a premium bump in the market compared to those who acquire other firms using their own stock. It supposedly sends a negative signal about what they think of their stock. If I think my stock is not worth $100, it's worth only 80, market attaches 100, of course I want to pay using stock. But if I think it should be worth 150, why would I pay with something that's worth 150 to me instead of $100 actual cash? That's how market thinks about it. From this, you deduct short-term financial obligations. In fact, some people go even further. They even deduct long-term debt as well. Not other long-term liabilities, but at least at a minimum, sometimes this is also known as net financial obligations. Then I can make a comparison. Because think of this. EV is, if I did EV per share, that would be market price plus liabilities per share minus net cash per share, right?